Hi everyone, this is Bilal Miraki. I'll be summarizing the article is published in Journal of Accountancy Auditing section. It was published in July 1st, 2019. The article is about the evaluation of internal controls and it's based on a survey conducted by AICPA where 400 accounting firms were peer reviewed, and out of those 400, almost half of them were not in compliance with the standard 315 and 330 AU section C. So the author came out with five missteps. The first one is assuming no internal control. Authors tend to assume that small clients do not have internal controls, which are not necessarily true because all clients have internal control. For example, if they have a credential, username, or password for their computers, that is internal control. Or if they simply have some sort of competency requirement for their auditor, for their accountant or bookkeeper, that is internal control. So it's not possible a client does not have internal control. All clients have internal control. It's not possible to do audit if there is no internal control. And the second one is the not understanding related controls. Uh, Auditors would go with the planned controls that needs to be evaluated, but they might have came across some situation where they would need to go further than what they have planned and understand other controls that would lead them to a material misstatements in the financial statement. And the third one is stopping after determining whether controls exist. Some of the auditors think that their responsibility is only to determine whether control exists or not, but that is not true because the scope or the extent of their responsibility also encompasses determining controls, evaluating the design of those controls, implementation of those controls, and evaluating the effectiveness of those controls. And the fourth one is improperly assessing control risks. Let me just summarize it with a brief example. For example, if an auditor's manual states that all bank statement needs to be reconciled by a bookkeeper, that is a control existence, but the implementation of that would be whether an actual person, a bookkeeper, is there to evaluate those, to reconcile the bank statement, and determining the risk or effectiveness of those control would be the auditor performing the task or recalculation the ratios in all those recalculation. But auditors sometimes default that, which is not a good approach. The fifth one is failing to link further procedure to control risks. Most of the times, the auditor would go with the previous year audit procedure that they had with the same client, or they would simply go with the audit procedure that they had with another client with the same industry. But keep in mind that all clients are different, even if they are operating in the same industry. For example, client A, they are recording their invoices into their accounting systems without matching them with the PO or getting approval. That is a deficiency where an invalid invoice could get into the system. And at the same hand, on the other hand, there would be a client where they are recording their invoices after payment. There is a deficiency that there might be valid invoices that are not in the system. So in this case, the accounts payable overstated and understated. So even though they are operating in the same industry, but they would need different audit procedures to address those deficiencies. Thank you for your attention. Those are all 5 bullet points. Thank you. Thank you very much. Have a good day.